You've heard it over and over. Once you hit £100,000, your savings will explode. But what if I told you that's just not true? Today, we're going to dive into why your money doesn't just magically start growing faster once you hit that milestone, and when you can actually expect your savings to take off. Stick around because you're about to learn the truth that most financial gurus won't tell you. Charlie Munger, the legendary investor, once said, "The first £100,000 is a B. But you have to do it." And you know what? He's absolutely right. But here's the catch. Once you've crossed that £100,000 threshold, things don't just take off the way you expect. You've got to work to make the growth happen. Let's break it down. Here's what happens when we look at the numbers. If you invest £200 per month into an index fund tracking the S&P 500, which has returned on average 10% since 1957, it will take you 17 years to reach the first £100,000. 17 years. And now, to go from 100,000 to 200,000 pounds, it takes just 6 years. Is that explosive growth? No, it's progress, but not the magic breakthrough you were hoping for. Here's the interesting part. Once you cross 200,000 pounds, things really start to accelerate. The time it takes to hit each new milestone shrinks significantly. That's when the real compounding power kicks in. So why doesn't the magic happen right away? Here are 3 main reasons. 1. Inflation is your silent enemy. Let's say you're getting a 7% return. Inflation is quietly working against you. If inflation is at 3%, your real return is only 4%. Imagine investing all that money, but when you get to the finish line, you realize the value of your investments is nowhere near what you thought it would be. Your £1,000,000 doesn't go as far as it used to. 2. The market doesn't always reward you. It's easy to get excited about compound interest, but the market can be unpredictable. One year, you see big returns. The next year, the market tanks. The best investment strategies take time, and during periods of volatility, it can feel like the market isn't rewarding your patience. 3. Compounding takes time. Compounding isn't some instant magic trick. It's like rolling a snowball. Slow at first, but it builds momentum over time. It doesn't just start exploding right away. It takes years to reach that tipping point where you're seeing real tangible results. But once you get there, the effect is powerful. Okay, so when does the real magic happen? First, growth takes time. The real growth happens later, after you've crossed that first milestone and built a foundation. Once you get to about £200,000, you start to see the compounding effect really kick in. That's when the growth starts to feel significant. 4 years to hit the next milestone, which is £300,000, and just 2 years to go from 300 to 400,000 pounds. That's nearly £500,000. 2. Bigger contributions equal bigger growth. Your portfolio doesn't just grow because the market's doing well. It grows because you keep adding to it. As your income increases, you put more money into your investments, you start seeing growth in a way that feels exponential. 3. Understanding market cycles. While we can't predict the market's every move, cycles are inevitable. The smartest investors know that market downturns offer huge opportunities. When the market dips, that's when you should be investing more. And when it recovers, you see your portfolio take off. Past experiences have shown that it takes anywhere between 2 to 12 trading days for the stock market to bounce after a correction or a market crash. So if your savings don't explode right after £100,000, what should you be doing to accelerate your growth? Here are some actionable steps. 1. Increase your contributions. You can't expect to grow your wealth if you're not contributing more. Find a way to increase your savings. Even small adjustments make a big difference over time. 2. Diversify your investments. Don't just rely on one type of investment. Mix things up to protect yourself from market fluctuations and ensure more consistent growth. 3. Take advantage of market cycles. The best time to invest is when the market is down. Don't wait for the perfect time because that moment may never come. Use volatility to your advantage. 4. Reinvest your earnings. Instead of taking your profits out of your portfolio, reinvest them. Let your returns work for you and accelerate the growth of your wealth. Your portfolio won't explode after you hit £100,000. Compound interest takes time. But once you get past that milestone and continue contributing, the real exponential growth will start. Now, I want to hear from you. How long did it take you to reach your first £100,000? Or what's been your biggest challenge in growing your wealth? Drop a comment below and let's learn from each other's experiences. Now, check out this next video on the biggest lie the investment industry ever told you to get the full scoop on compound interest. It's packed with even more insights into the myths and realities of investing. If you found this video helpful, make sure you like, subscribe, and turn on notifications so you don't miss future updates. See you in the next video.